We have now taken a look at how to do adjusting entries, prepare the adjusted trial balance, and the financial statements. After financial statements have been prepared, we go through the process of closing temporary accounts. So in exercise 317, we will see how to do closing entries. So here we have a company that's fiscal year end is December 31st, 2024. The following is a partial adjusted trial balance. So they've not given everything. They've just given us the accounts that are relevant for closing. So in closing, we have 3 sets of journal entries. You'll definitely have 2. You may or may not have the third one. Your income statement accounts, which is your revenues and your expenses, must be closed. You have to bring them down to zero balance. You transfer the amounts into retained earnings, which is stockholders' equity. Another account that needs to be closed is dividends. If dividends were paid, they were paid out of retained earnings. So that dividend account needs to be closed to retained earnings. So we always do it in this order. First close the revenue accounts, then close the expense accounts, and then dividends. So we have retained earnings that has a 30,000 credit balance. So I have a T account over here, and I will write down my retained earnings beginning balance of 30,000 over here. I have dividends of 3,000. I'm going to come to that last. So this is going to be my third closing entry that I will do. I always start out with my revenues. So I have 2 revenue accounts. I'll highlight these over here. I have 2 revenue accounts. And these 2 revenue accounts are the first ones that I'm going to close. So I'm going to write number 1 for these to indicate that these are the first that are getting closed. Service revenue and interest revenue both have a credit balance, obviously. I want to close them. So to close them, I obviously need to do the opposite, which would mean I'm going to debit those 2 accounts and I will credit retained earnings. Now think about it for a minute. Retained earnings is an equity account. Normal balance for equity accounts is credit. You increase it with a credit. So the revenues are going to increase my retained earnings, 56,000. Next, let me take a look at my expense accounts. This is the second group that I'm going to close. First was revenues. So I'm writing the number 2 here to indicate this is the second one. Salaries, rent, advertising, insurance, and interest. All of these need to be closed. These accounts all need to get closed. They all have a debit balance. So to close them, I'm going to credit all these accounts. I have to credit these accounts in order to close them. So I'll first leave one line and then write down all the accounts that you're going to credit. And then this total amount will be debited to retained earnings. Again, let's think about this. What do expense do? What's the effect of expense on equity? Expense is going to decrease the owner's equity. Remember, revenue minus expense gives you net income. Expenses are decreasing owner's equity. So retained earnings is debited 40,000 in order to decrease it. Finally, let me go to this dividends. Let me highlight this one over here, dividends. Let me go to this number over here and highlight it so we can see this. Okay. So dividends has a debit balance of 3,000, just like expenses, dividends has a debit balance, which means I need to credit dividends 3,000 in order to close it. And again, I will debit retained earnings, 3,000. Retained earnings will be debited 3,000. Dividends are paid out of retained earnings. Retained earnings has a credit balance. If I pay the dividends out of retained earnings, I'm decreasing it. Now, finally, I'm done with all my closing entries. I need to find the balance in my retained earnings account. So I added up the 2 sides. And finally, I'll put the number on the credit side. 86 minus 43 is 43. This is my ending balance, my final number that I have over here. Okay, again, to recap, what we have over here is in all these entries, in the closing entries, you must debit or credit retained earnings. While you can't go willy-nilly and do however you fancy, retained earnings is credited, revenues are debited, retained earnings is debited, expenses are credited. So you're doing the opposite. So after you're done with this, of these accounts, which one is left? Only retained earnings with a balance of 43,000. All of these are going to drop off, they're going to become zero. When you prepare the post-closing trial balance, what are you left with? Assets, liabilities, owner's equity. Only balance sheet accounts will move into the next year. So the purpose of the closing entries is to zero out revenues, expenses, and dividends, and to move all of those amounts into retained earnings. So it's fairly straightforward on the computer. If you had a computerized software, this is a very easy step. You can just say, prepare closing entries, and it'll do it automatically for you. But you need to know which accounts are getting closed. You shouldn't worry as to what happened to certain accounts. These accounts will all close on December 31st after financial statements have been prepared. And then you're ready to start the new year with zero balances. With that, we finish this exercise and move on to the next one.